Usually when you buy a coffee, your banking app just shows this really clean transaction, right? Like $4.50.
Yeah, exactly. You just look at your phone.
Right. You point at the screen. You're like, there it is. That's what I spent.
Yeah.
It's money out, coffee in. It's binary. It's clean. And, it's comforting.
Right.
We naturally just expect our financial data to be visible and perfectly categorized like that.
I mean, we do. But step into the world of multinational corporate finance, and that clean visibility it shatters entirely.
Oh, completely.
You aren't just dealing with a few neat transactions. You're dealing with a reporting landscape that is structurally fragmented across dozens of different currencies, localized accounting laws, and entirely distinct software architectures.
Right.
It is a level of complexity that, frankly, threatens to completely obscure the actual health of a business.
It is basically the definition of diagnostic muddy waters. And today, we're diving straight into how massive organizations untangle that sheer web of global finance at the end of every single month.
Yeah, the famous period end close.
Exactly. So for this deep dive, we'll be unpacking the mechanics of Mondial. It's a financial reporting and consolidations platform, or FRC for short. And it essentially acts as a digital universal translator for this corporate data chaos.
Which is such a massive undertaking.
It really is. And,
Yeah.
to the listener, even if you aren't an accountant and your eyes glaze over at spreadsheets, the way this system systematically solves these massive data aggregation puzzles is it's a serious aha moment for anyone dealing with complex multi-source information.
Oh, absolutely. The fundamental issue we have to understand first is just the sheer heterogeneity of the data.
The chaos, basically.
Right, the chaos. Imagine a massive corporate head office trying to understand its global position. They might have, say, a subsidiary in the UK running their daily operations on Sage software.
Okay.
But then another in Germany is using Acumatica, and an acquired company in Japan is running some legacy on-premise system.
Wait, so they're not even using the same software to talk to each other?
Not at all. And it isn't just different software brands, They are transacting in completely different currencies. Pounds, euros, yen.
Right.
And they're operating under completely different regulatory standards. So the U.S. entity is reporting under U.S. GAAP, while the European entities are using IFRS. They even have different financial year ends. The actual architecture of their ledgers is fundamentally misaligned.
Okay, let's unpack this. I picture it like a massive, chaotic, global potluck dinner.
I like that.
Right. Everyone shows up to bake this massive cake, but they've measured their ingredients in wildly different units. Someone brings cups of flour, someone else brings grams of sugar. One oven is set to Celsius, the other is in Fahrenheit.
And no one knows how to convert anything.
Exactly. And this FRC platform is basically the master chef taking all these random incompatible inputs and converting them into a single coherent recipe.
That is exactly what it does. It normalizes everything into one central chart of accounts and translates the currencies.
But wait, if you're hoovering up millions of transactions from these distinct architectures and you're flattening them into one standard format, aren't you inevitably losing the granular details?
That's a really common fear.
I mean, if you standardize millions of rows of data just to get a clean summary, it seems like the system would just strip away the crucial context you might need later.
And that is the exact trade-off most legacy systems actually force you to make.
Right.
But what's fascinating here is how modern FRC architecture fundamentally shifts that paradigm. The data isn't just grouped and forgotten.
So it remembers where it came from.
Yes. The platform retains this incredibly deep drill-down capability. Users can investigate any top-level balance by clicking all the way down to the individual line items.
Really? All the way down?
All the way down. It leverages the existing, substantial investment in those ERPs rather than overriding them. So suppose an auditor is looking at a top-level consolidated balance for European marketing spend. Say it shows a summary figure of 20 million euros.
Okay, a big chunk of money.
Right. And if they question the validity of that number, they don't have to call the German office and wait for someone to manually dig through file cabinets.
Oh, thank goodness.
The user just clicks on that 20 million euro consolidated balance, and the system unpacks it layer by layer. It drops down from the consolidated view into the regional view, into the local German ledger, all the way down to the specific original journals and invoices.
Wait, so you can trace a multi-million-dollar global summary straight down to, like, the individual receipt for catering at a specific event in Berlin?
Exactly. From the central interface, it ensures every aggregated number is verifiable for audit and control.
That is wild.
Yeah.
But, once you finally force all these subsidiaries to speak the same data language, it accidentally exposes this massive new problem.
Right, the intercompany headache.
Yes. Suddenly you have crystal clear visibility into how often these internal companies are doing business with each other.
Which creates a unique kind of mathematical hazard, untangling that web.
Here's where it gets really interesting to me. I kept thinking about Venmo.
Venmo.
Yeah, so if you share a joint bank account with your spouse and you Venmo them $50 for dinner,
Okay, I fall.
your personal app shows you spent $50 and their app shows they gained $50. But from the perspective of the household as a whole, no actual new money was generated.
Oh, right.
The household didn't get $50 richer. It has to be canceled out on the master ledger.
And in corporate finance, we call that intercompany elimination. And the stakes are obviously a bit higher than a dinner bill.
Just a little bit.
If the UK subsidiary sells $1 million worth of software licenses to the German subsidiary, the overarching parent company hasn't actually generated external revenue.
It's just moving money from its left pocket to its right pocket.
Exactly. And if you consolidate their ledgers without stripping that transaction out, you are double counting your sales and artificially inflating the revenue of the global entity.
Which is a fantastic way to end up in severe legal trouble.
Oh, absolutely. But doing it manually is highly time-consuming because of mismatched charts, wrong fiscal periods, or just slight human errors in references.
So how does Mondial actually handle that?
It automates it using a dedicated intercompany module. It has 5 tabs, but the crucial one is the Relationships tab. It explicitly maps corresponding accounts, like Company A's payables to Company B's receivables.
So it builds the taxonomy.
Yes, and then the system auto-matches the transactions based on criteria like date, amount, and reference.
But wait, if an algorithm is doing all this auto-matching in the background out of sight,
Yeah.
how do we trust it isn't just automatically hiding human errors to make the books balance?
That's a great point.
Like, if there's a discrepancy, wouldn't an aggressive algorithm just force a match and sweep it under the rug?
This raises an important question, and it's exactly what auditors look for. But instead of hiding errors, the system specifically separates the auto-matched items from the unmatched items.
Oh, so it isolates the problem.
Yes. For example, the source mentions a scenario where £74,000 was posted by one entity, but only £66,000 was matched on the other side.
Leaving, what is that, an 8,400 pound difference?
Exactly. And rather than burying that, it isolates it, flags it for human review, and creates a full downloadable audit trail.
So it points a big red arrow right at the discrepancy.
Yes. And they actually mention an upcoming algorithm that will act like a digital hound dog.
Wait, really? A hound dog?
Yeah, it will actually go out into the rest of the accounting system to actively hunt down exactly where that missing money was mistakenly posted.
That is incredible. And once it's found...
Once the human confirms it, FRC automatically creates a journal entry to eliminate those transactions so they aren't double counted in the final consolidation.
Okay, so the intercompany tangles are smoothed out.
Mm-hmm.
But from a logistical standpoint, how does a CFO actually keep track of this entire process across dozens of global companies without losing their mind?
They use what the system calls the period end dashboard.
Right, the CFO's control tower.
Exactly. It's a grid of color-coded boxes tracking tasks like management reports, reconciliations, and revaluations for every single company.
So they can see everything at a glance.
Yeah, it tracks who is responsible by their initials, due dates, and even custom notes. Like, you can overwrite a due date with a note explaining, this person was ill.
Oh, that's really practical.
Huh.
But I also saw that the system features these enterprise group hierarchies.
Yes, offering ownership and tree views.
Right. It groups by legal ownership to see if a company crosses the 50% threshold for full consolidation.
But why do we need different hierarchies?
What do you mean?
I mean, if a parent company owns a subsidiary, isn't ownership just ownership? Why complicate it with regional or industry or tax hierarchies?
Well, you have to remember that a business isn't just a legal entity on paper. It's a living organism.
Okay, I like that.
Legal hierarchies strictly dictate what needs to be consolidated for external compliance. But viewing the group regionally or by industry allows executives to actually analyze operational performance. Oh, so they can see if the Asian arm is doing better than the European arm, regardless of the legal structure.
Exactly. And furthermore, the hierarchy actively dictates which intercompany eliminations apply at which subgroup level.
Oh, wow. So it changes the math based on how you're looking at it?
Yes, ensuring the math is perfectly tailored to the specific lens the CFO is looking through at that exact moment.
That is incredibly sophisticated. So what does this all mean? We have this cutting-edge, highly secure, mathematically perfect, cloud-based reporting engine. When the board of directors sits down to look at the final data, what futuristic interface do they use?
They use old-fashioned Microsoft Excel.
I have to laugh at the irony of that. We have this cutting-edge global software, and they still just want to use spreadsheets.
It's true.
Isn't hooking this up to Excel like putting a Ferrari engine inside a horse-drawn carriage?
I get why you'd say that. But if we connect this to the bigger picture, this is exactly why this software was built by accountants for accountants.
Because accountants love Excel.
They absolutely love it because it's flexible and it's great for building beautiful presentations for boards and auditors.
But Excel is notoriously error-prone.
Mhm.
I mean, broken links, copied and pasted static values that have zero context.
Which is exactly why FRC solves this with an Excel add-in. Their philosophy is basically FRC keeps the data right, while Excel makes it look right.
Okay, so how does the add-in work?
It populates existing Excel templates directly with FRC data. It brings all those strict data integrity controls and the exact same drill-down capability we talked about directly into the spreadsheet.
Wait, so the drill down works inside the local Excel file.
It does.
So if an auditor clicks a cell in a spreadsheet, they can trace it all the way back down to that original invoice in Berlin.
Exactly. Without ever leaving Excel, instead of forcing users to abandon the tools they are comfortable with, FRC just removes the danger from the tool.
That is brilliant user-centric design.
And it doesn't stop there. The system also supports multi-output options like iXBRL for regulatory bodies, PDF, and even direct export to Adobe Illustrator for publishing.
Sending verified data straight into graphic design software. That is wild.
It just shows how flexible verified data can be.
It really does.
Yeah.
So to summarize, FRC essentially acts as this digital control tower. It normalizes chaotic data. It automatically untangles those massive intercompany transactions. It visualizes the workflows for the CFO, and then safely delivers the final numbers into familiar tools like Excel.
That's a perfect summary.
And to you listening, whether you're a finance professional or just someone trying to manage diverse streams of data in your own life, the principle here is huge. Centralizing and verifying information all the way back to its source, it's an absolute game changer.
It really is the only way to build trust in your numbers.
Absolutely. But before we wrap up this deep dive, I want to leave you with one final thought to mull over.
Oh, here we go.
Think about it. If software algorithms are now capable of automatically matching millions of global transactions and actively hunting down a single 8,000-pound discrepancy across international borders and currencies.
Doing the heavy mechanical lifting.
Yes, exactly. Will the traditional role of the number-crunching accountant eventually disappear entirely?
It's a serious question.
And if the machine is doing all the math, what kind of strategic superpowers will the accountants of the future have to master instead? Something to think about the next time you look at that simple $4 coffee transaction on your phone. Thanks for joining us on this deep dive.